After 2 turbulent years of tension and tariffs, a rare wave of optimism is sweeping through the global markets. Next week, the world's 2 largest economies, the United States and China, are expected to officially sign a new trade agreement. This isn't just another diplomatic gesture. It's the first real sign of stabilization in U.S.-China economic relations since early 2023. The announcement came through U.S. Treasury Secretary Bessent in an exclusive Financial Times interview, confirming that both sides have reached balance and can work within this framework for the next 12 months. At nearly the same time, China's Ministry of Commerce issued a statement confirming that key consensus was reached during trade talks in Kuala Lumpur. Both capitals, Washington and Beijing, are signaling coordination, a rare alignment after years of tariffs, export bans, and mutual suspicion. Markets immediately reacted. The Chinese yuan rose modestly in offshore trading. Asian equities climbed, led by logistics and manufacturing stocks. Commodity and shipping sectors saw short-term rallies. For many investors, this deal represents more than tariff relief. It's a symbolic turning point. It says, the U.S. and China can still do business. Now, let's break down what this deal really means and why it matters so much for global trade, manufacturing, and the macroeconomic balance of power. The first takeaway is clarity. For months, speculation has surrounded whether the U.S. and China could find a way to pause their economic standoff. Now, confirmation has arrived. Treasury Secretary Bessent stated in her FT interview that both sides have reached balance, meaning they've found a formula acceptable to both Washington's political needs and Beijing's economic priorities. That phrase, work within this framework for the next 12 months, is crucial. It implies that the deal is a 1-year stabilization pact designed to stop the trade relationship from deteriorating further while both governments navigate their domestic political calendars. From Beijing's perspective, this deal represents strategic breathing space. China has been pushing to restore manufacturing momentum and export competitiveness amid slowing global demand. The easing of tariffs and export controls directly helps that effort. From Washington's view, the U.S. gets cooperation on fentanyl-related enforcement and a temporary reduction in import costs, both politically valuable outcomes. The symbolism is equally powerful. Since early 2023, bilateral relations have been dominated by tech sanctions, semiconductor bans, and defense tensions. Now, economic pragmatism is returning. Markets read this not as friendship, but as rational cooperation, and that's enough to lift global confidence. The deal's content is remarkably detailed, and that's what gives it weight. Let's walk through the core provisions. Tariff relief. The U.S. will cancel the 10% fentanyl tariff on Chinese goods, a politically charged measure introduced earlier this year. In return, China agrees to expand joint enforcement on synthetic opioid supply chains. More importantly, the U.S. will suspend the 24% retaliatory tariffs for 1 year, immediately lowering the cost of Chinese imports. Export controls. Washington's September 29th export control rules, which restricted Chinese access to advanced industrial and semiconductor materials, will be paused for 1 year. In reciprocity, Beijing will pause its October 9th countermeasures on rare earth export licensing and critical minerals. Maritime and logistics. Both sides suspend the Section 301 investigations and port-related tariffs for 1 year. This reduces costs for shipping companies and restores predictability in global supply chains. Additional cooperation. The deal includes a symbolic clause on joint anti-fentanyl enforcement and an agricultural trade expansion initiative, reopening channels for U.S. farm exports. What this deal represents is a mutual timeout. It doesn't end the strategic competition, but it puts the economic confrontation on hold, at least temporarily. For businesses and markets, this year-long pause provides something invaluable: predictability. Here's where the deal's real impact shows. According to analysis from CICC and Huatai Securities, the combined tariff and export control suspension could lift China's exports to the U.S. by 10 to 15% over the next 12 months. Before the deal, the effective U.S. tariff rate on Chinese goods was around 27%. With these new suspensions, that rate drops to approximately 17%. That 10-point reduction directly translates into a boost for Chinese exporters' profit margins and pricing competitiveness. CICC estimates that the new arrangement could lift China's U.S.-bound exports by around 10%, while Huatai sees a more optimistic 15% boost, enough to lift China's total export growth by roughly 2.2% in 2025. The industries that benefit most include general manufacturing plus 6.0%, stationery, toys, and sports goods plus 5.8%, furniture plus 5.8%, electronics and telecom equipment plus 5.4%, apparel and textiles plus 5.3%. These are not high-tech sectors, but traditional export engines employing millions. The deal helps stabilize exactly those industries hit hardest by global slowdown and tariff uncertainty. For the U.S. consumer, this could also mean slightly lower import prices, especially in household goods and electronics. In other words, inflation relief might arrive indirectly through lower import costs. The logistics and maritime sectors stand to gain significantly. The suspension of port-related tariffs and Section 301 measures will directly cut costs for shipping companies operating between Chinese and U.S. ports. Container traffic between Shanghai, Ningbo, and Los Angeles is expected to rebound sharply as trade friction eases. Shipping companies benefit in two ways. One, trade cost relief. Reduced tariffs and smoother customs procedures improve efficiency and margins. Two, demand growth. As more goods move across the Pacific, container and bulk shipment volumes increase, supporting both freight rates and ship utilization. Moreover, this deal arrives just as OPEC's production growth and U.S. sanctions on Russian oil are tightening global shipping capacity. This means higher demand for very large crude carriers and bulk vessels, and potentially higher freight prices in the short term. In short, logistics, oil transport, and shipping firms are looking at a dual benefit: lower policy friction, higher demand. By stabilizing trade routes, the deal also reduces uncertainty for insurance, warehousing, and port operators, providing a ripple effect of optimism across supply chains. Finally, the currency and strategic picture. The renminbi has been under pressure for much of the past year due to global dollar strength and capital outflows. This trade deal offers some relief, both psychological and fundamental. By boosting China's export competitiveness and improving trade balance, the RMB gains a natural appreciation driver. Analysts expect the yuan to strengthen modestly through late 2025, especially if rate spreads between China and the U.S. continue to narrow. But beyond short-term currency moves, there's a broader lesson here. China's exporters have proven resilient, even under intense tariff pressure. Despite facing a 145% cumulative tariff burden this year, exports still grew 6.2% year-on-year. That resilience shows the adaptability of China's manufacturing base, its ability to shift markets, upgrade production, and maintain scale. Going forward, experts recommend 3 long-term strategies. 1. Diversify export markets. Reduce reliance on U.S. demand by expanding in ASEAN, Middle East, and Latin America. 2. Invest in industrial upgrading, automation, green manufacturing, and high-value components. 3. Prepare for future shocks. Treat this one-year deal as breathing room, not permanent peace. In short, this agreement is a pause, not an ending. But even a pause matters, because it resets the tone of global trade and gives businesses the space to plan again. As one analyst put it, after years of escalation, stability itself is now the most valuable commodity.